Venture capital is a type of financing in which funds are provided to early-stage, nascent enterprises with great development potential in exchange for stock or a part in the company. Individuals assume the risk of investing in budding companies in the aim of earning big returns when the companies succeed. The returns to these investors are determined by the company's growth. Ventures, as defined, include risk in exchange for a sizable reward. A venture capitalist is a private equity investor who funds startup projects or assists small businesses that want to grow but lack access to equities markets. Venture capitalists assume the risk of investing in young firms in the goal of earning large returns when the companies succeed. They have enough wealth to bear the risks associated with investing in uncertain, high-risk businesses. They assess the company's development potential, the strength of its management team, and the distinctiveness of its products or services when deciding which companies to invest in. Because it is their money at stake, venture capitalists have the ability to influence significant decisions made by the companies in which they invest. Venture capital is often raised from institutional investors and high-net-worth people, and it is pooled by specialized investment firms. In a venture capital transaction, huge pieces of a company's ownership are generated and sold to a few investors via independent limited partnerships established by venture capital firms. Venture capital businesses are typically organized as limited partnerships, with partners investing in the VC fund. Once potential rising growth companies have been discovered, the pooled investor capital is used to support these firms in exchange for a significant equity stake. Venture capital is the best option for funding a high-priced capital source for firms, especially those with substantial upfront capital requirements that have no other cheap options. Venture money bridges the gap between sources of funding for innovation and traditional, lower-cost forms of finance available to existing businesses. To properly bridge that gap, the venture capital business must give a sufficient return on capital to attract private equity funds, attractive returns for its own members, and sufficient upside potential to entrepreneurs to attract high-quality concepts with high returns. Aside from financial support, gaining venture capital financing can give a vital source of counsel and consultation to a startup or small business. This can aid in a range of corporate decisions, including financial and human resource management. Making smarter decisions in these critical areas might be critical as your company grows. A venture capital firm can provide active help in a number of essential areas, including legal, tax, and personnel problems, which is especially important at a critical moment in the growth of a fledgling company. Two potential important benefits are faster expansion and higher success. Venture capitalists are typically well connected in the business sector, which could be extremely beneficial. The disadvantages of equity financing in general can be amplified by venture capital investment. The VC partners are likely to want to be involved, especially if they are professional, aggressive investors bringing substantial capital influx. The level of their investment may decide how much influence they have over the path of the entrepreneur's company. The entrepreneur may lose managerial control depending on the level of the VC firm's holding in the company, which may be greater than 50%. Essentially, the entrepreneur may be relinquishing control of their company. New companies frequently fail, which means that early investors may lose all of their money. A general rule of thumb is that 3 or 4 startups out of every 10 will fail. Every business has a life cycle, and each stage necessitates a unique set of management skills. The person who starts the business is rarely the one who can grow it, and the person who grows the business is rarely the person who can head a much larger organization. As a result, it is unusual that the founder will also be the person who takes the business public. Ultimately, the entrepreneur must demonstrate to the venture capitalist that his team and idea are a good fit for the VC's present focus, and that his partnership and managerial abilities will make the VC's job easier and the returns higher. Once the entrepreneur understands the demands of the financing source and properly sets expectations, both the VC and the entrepreneur can reap greatly.